On paper, a corporate balance sheet looks perfectly clean, but generating those pristine numbers requires operating in dark, toxic, and dangerous industrial environments. Since 1997, 5E Resources has built its business in exactly this kind of environment. They are a veteran scheduled waste management provider in Malaysia. Now, they are taking that decades-long track record to the public markets, scheduling an initial public offering on the ACE market of Bursa Malaysia. The company aims to raise 79.2 million ringgit to fund their next phase of expansion. For retail investors looking to participate, the entry price is set at 26 sen per share. This presents a compelling conflict. The financials show a highly profitable enterprise protected by a massive economic moat. But the daily operations are a hyper-regulated minefield where one mistake can shut everything down. To figure out if 26 sen is actually a fair price, we have to weigh the power of their government-mandated pricing power against the constant looming threat of a forced operational shutdown. 5E Resources makes its money by collecting, transporting, and treating hazardous industrial waste, with their primary market focused down in Johor. They also run what they call a circular economy model. Instead of just disposing of the waste, they extract and recover salvageable chemicals from it, selling them back into the industrial supply chain. These aren't materials you can just throw in a landfill. The Department of Environment, or DOE, classifies these hazardous byproducts under strict waste codes. Handling any single code requires highly specialized, heavily monitored licensing. That means 5E's entire revenue stream is completely dependent on keeping the regulators happy and maintaining the exact licenses required to legally touch these materials.
Let's look at how that licensing actually works to their advantage. Out of the 77 possible waste codes established by the government, 5E currently holds active licenses for 34 of them. Getting approval to handle hazardous waste requires massive capital, environmental impact assessments, and strict facility audits. That scarcity creates an extreme, government-enforced barrier to entry. New competitors simply cannot pop up overnight. This chart shows what that lack of competition does to their pricing power. 5E enjoys gross profit margins hovering around 45%. After accounting for expenses and taxes, their profit after tax margin consistently nears 30%. Over the 3 fiscal years leading up to this IPO, those margins have remained remarkably stable. They achieve these returns while using almost no borrowed money. As of late 2025, their debt-to-equity ratio had dropped to a staggeringly low 1.34%. When you put that all together, 5E Resources looks like a financial fortress. They generate massive cash flow from captive customers, and carrying almost no debt means they are completely insulated from sudden interest rate shocks. But there is a catch. Those mandatory Department of Environment licenses that create their moat, they aren't permanent. They have to be renewed every single year. The company operates perpetually at the mercy of government regulators. If an unannounced inspection uncovers a violation, or a facility fails an audit, the DOE can suspend or revoke a license, instantly freezing that revenue stream. And while the barriers to entry are high, 5E is not alone. As of early 2026, there are 373 licensed scheduled waste operators across Malaysia. The true threat comes from the upper tier of that group. 74 of those operators are licensed to handle more than 10 different waste codes. To defend their market share against these elite rivals, 5E has to constantly pour money into research and development to figure out new ways to process complex waste. So the financial moat is undeniably wide and deep, but the drawbridge is controlled entirely by yearly government approvals. To understand the reality of that regulatory risk, we have to look at what happened in September 2025, just months before this public offering. A chemical reaction occurred in one of their temporary wastewater storage areas, known as Pit 6. The reaction released highly toxic hydrogen sulfide gas, resulting in the tragic deaths of 2 workers and the hospitalization of another. The regulatory response was immediate. The Department of Occupational Safety and Health stepped in and issued prohibition notices, forcing the total and immediate suspension of all operations at Pit 6 until corrective actions were implemented. This was not their first encounter with the authorities either.
Back in 2022, the company was hit with 67,000 ringgit in fines across 74 compounds after the DOE found various non-compliances during facility inspections.
In this sector, safety failures act as a direct toggle for an operational shutdown. Beyond the human cost, these accidents create immediate revenue-halting suspensions and severe headline risk. With those two opposing forces on the table, we can finally run the math. We need to weigh the fortress-like financials against the physical operational risks to see if 26 sen is actually a fair asking price. This animation maps out the valuation. After the IPO, the company will have an enlarged share base of 1.54 billion shares. Multiply that by the 26 sen entry price, and we get an implied market capitalization of roughly 400.4 million ringgit. For fiscal year 2024, they generated 21.78 million ringgit in profit after tax. Divide that profit by the 1.54 billion shares, and you get an earnings per share of roughly 1.41 cents. Finally, we take that 26 cent share price and divide it by the 1.41 cent earnings. That leaves us with an implied price-to-earnings ratio of approximately 18.4 times. Paying 18.4 times earnings for a company with a debt-free balance sheet and net margins pushing 30% is entirely reasonable in a vacuum. However, that multiple leaves absolutely no margin of safety for the severe regulatory and physical risks we just discussed. At this valuation, you are paying a premium price for the economic moat, but you aren't getting any discount to compensate you for the hazard of the work. If you are the type of investor who prioritizes high margins and government-enforced barriers to entry, and you have the stomach to handle occasional regulatory fines and suspensions, then this IPO warrants a buy or hold consideration. You just have to be comfortable paying that 18.4 multiple to get access to the cash flow. Conversely, if you are a risk-averse investor who loses sleep over operational halts, fatal workplace accidents, and the annual anxiety of government license renewals, then this is a strict avoid. The catastrophic financial risk of the DOE deciding to permanently revoke a waste handling license is simply too high to ignore. If you are on the fence, the single most important catalyst to watch is their very first quarterly earnings report as a public company. That report will reveal exactly how much financial damage was done by the suspension of Pit 6 late last year. Because ultimately, paying 26 cents a share is only a fair deal if management can prove that the recent tragedy was an isolated operational anomaly and not a systemic flaw.